Death sucks. But there are two amazing things that happen when you die. Number one, when you pass away, your assets get what's called a step up in basis when they're passed on to your children, okay? Now, what does step up in basis mean? Think of it as the IRS giving your children a clean slate from your previous tax bill. So how does it work in today's practice? Let's say you bought a home for $100,000 20 years ago. And let's say at the date of your death, that home is now worth $1 million. So now you're going to pass down this $1 million home to your children. Now, most people would assume that the ownership is changing hands, that $900,000 in capital gains, somebody has to pay it, right? Because the property is now worth $1 million when it changed hands. But if you structure this correctly with the revocable living trust, you are able to pass down this $1 million property and your kids get what's called a step up in basis. So your kids receive the property at the fair market value of $1 million, but guess what? That $900,000 capital gains taxes that they were going to have to pay on that $900,000 of appreciated capital, it's wiped clean. So instead of having $180,000 capital gain tax bill, they now have a $0 tax bill because that property got what's called a step up in basis. Now, some of you are all thinking like, okay, Carter, that solves the tax problem, but what about the debt problem? Because if you borrow $100,000, $200,000, $400,000, $1 million, if you borrow $1 million of your assets while you're alive, somebody has to pay down that $1 million debt. And again, you would be right. Now, this is where life insurance comes in at the die part of this strategy. So when you're alive and you're borrowing the money against your assets to live off of, during this time, you also want to purchase a life insurance policy that is equal or more than the outstanding debt that you plan to receive. So if I know I'm going to borrow $1 million from my assets to live off of, I'm going to buy a life insurance policy that has $1 million plus death benefit. Why am I going to do that? That way, when I die, that $1 million life insurance proceeds goes down to my children. And in case you didn't know, life insurance proceeds are 100% tax-free. So now my kids can receive this $1 million life insurance proceeds tax-free, and they can use this $1 million to pay off the debts that I lived off of. So not only are we passing down tax-free assets to our children, but we'll also be passing down debt-free assets to our children.